Namaskar. This is Akhilesh Bhargava. Welcome to Tit-bits on Business and Finance with me. With Chinese investments now being denied an automatic approval into India, let's talk about China's investments into Italy, India, and where are they headed to. The Italian economy is considered to be the third largest in Europe, but Italy is still considered to be the sick man of Europe today. And that's because it is heavily indebted. The total debt of Italy as a country today stands at 2.5 trillion euros, which is extremely high and truly unsustainable. Its companies have always been financially stressed, and that is where China saw an opportunity long ago. China was ever keen to invest into European companies in order to gain access to technology, to infrastructure assets, to strategic assets, to brands, and most important, to gain respectability. Made in China as a tag does not command respect, while Made in Italy does. And for the Chinese companies, the Chinese government, it was an opportunity to monopolize these. Thus, from 2010 onwards, China started becoming a prolific investor into the Italian economy. Its FDI into Italy in 2010 was 100 million euros. By 2015, in a matter of 5 years, it had risen to 7.6 billion euros. And today, it cumulatively stands at 25.5 billion euros. That's the kind of stake that China has taken into Italian companies. And it has invested in companies there across the board, in big companies as well as in small companies. And today, there are over 200 companies of Italy which are owned by Chinese investors who reside abroad. And there are an equal number of companies owned by Chinese who are resident in Italy. That's the kind of investment that China has made into Italy. And by doing that, it has invested into technology companies, into banks, into finance companies, insurance companies, agricultural companies, textiles, infrastructure, strategic assets like ports, etc. That's been the range of investment that China has made into Italy today. It has invested into marquee companies like Fiat, Pirelli, Enel, ENI, Generali, Telecom Italia, and many others. And the disturbing part is that these investments of China into Italian companies are not by private sector Chinese companies, they are predominantly by state owned enterprises, by banks which are owned by the Chinese government, and most important, by the Central Bank of China, which is equivalent to the Reserve Bank of India. That makes it clear that these are investments made by China directly into Italy, and that is why it is now being said that China has colonized Italy. These investments are being now called predatory investments in order to gain political influence in a country. It is because of that in March 2019, Italy agreed to be a part of the Belt and Road Initiative of China, which none of the G7 countries have agreed to be. Italy has been the exception, and it signed 50 agreements to that effect. That was in 2019 March. Thereafter, we have seen COVID. Thereafter, we've also seen a situation where, because of the COVID rampage in Italy, the Italian stock markets have fallen by 40% and its economy is shrinking by 8%. That provides yet another lucrative opportunity for China to snap up in Italian companies, and alarm bells have now risen in the Western world. NATO has raised an alarm bell and has warned Italy that further opportunistic takeovers by Chinese companies are likely, and that would give access to Western sensitive assets and technology to China, which is so avoidable. It is because of that now that the tide seems to be turning in Italy against China. Very recently, the Italian government has objected to the human rights track record of China. That was surprising. It also supported the democracy movement in Hong Kong, and it is very likely that, like the US, even Italy will now ban UAE, the Chinese company, from taking any exposure to telecom assets or telecom machinery or equipment in Italy. Italy, like other European countries, now has started screening investments flowing into Italy from China. That's been the story of Chinese investments into Italy so far. Let's talk about India. With its own economy shrinking and its export markets abroad also contracting, China desperately needs a big market for its products, and a big market where it can also invest. And what better a country, what better an alternate than India with its huge population of 1.3 billion and a huge backlog of investment. Thus, we are seeing a rising wave of investment into India by Chinese entities, which of course are all state controlled, directly or indirectly. In the last couple of years, Chinese investors have been rising investors in India's startups, particularly in sectors of fintech, e commerce, logistics, digital technology, and others, such that today China is a bigger investor in these startups in India than even USA, which has so far been the traditional leader. In 2018, Chinese companies, Chinese investors invested $2 billion dollars in Indian startups in this sector. In 2019, it had almost doubled to $3.9 billion and it continues to rise. All the startup unicorns that are there in India, whether it is Ola, Oyo, Paytm, Zomato, Swiggy, Baiju, Big Basket, Policy Bazaar, etc., they all have Chinese investments in a big way. And let me point out that in China, when a state owned bank or a state owned enterprise invests into an Indian entity, indirectly, it is the Chinese army that invests because the People's Liberation Army in China is a covert and overt investor in all its banks, in all its enterprises. Thus, when Chinese investors invest in India in a big way, be clear, it is their government, it is their army which is investing in the country, which is so avoidable. It is because of this that the Ministry of Home Affairs, Ministry of External Affairs, intelligence agencies of India, and the Ministry of Finance have been very carefully watching the flow of Chinese investments into India. They have been noticing the rising FDI, and they have also been noticing the rising FPI into Indian stock markets from Chinese investors, and that has been a matter of concern. Perhaps what triggered the recent move by the government was the PBOC, the People's Bank of China, increasing its stake in HDFC, India's largest housing lender, to over 1% of its capital. That was an alarm bell which says action needs to be taken. Action also needs to be taken because today, like any other country, India's stock markets have seen a huge collapse in values. The market capitalization has evaporated by 1/3, which means the enterprises are available for a takeover at a much lower valuation, giving an opportunity for opportunistic takeovers by any predator, which very likely could be Chinese entities. Thus, the Ministry of Commerce very recently announced a change in FDI guidelines. It said that any entity, any investor which originates out of any country which shares a border with India, it will now need a prior approval by the government of India. These investments originating from these countries which have a common border with India will now not be able to get into the automatic approval segment. And that thus includes Pakistan, Bhutan, Nepal, Bangladesh, Myanmar, and of course, China. The real purpose is, of course, to block Chinese investments into India. They will not get a smooth entry. They will now be subject to government approval. China has been keen to invest in India's technology, pharma, manufacturing, infrastructure assets. But now with this, a break, a screening, a check, a due diligence is bound to happen. They will not just flow in. Along with this move by the Ministry of Commerce of ensuring that any FDI approval that originates from these countries, whether directly or indirectly, will need a prior government approval. Even SEBI has started investigating into all the FPI investments which have flown into India from Hong Kong, from Pakistan, from Bangladesh, Singapore, Mauritius, and any other center to see who are the ultimate beneficiaries of those FPI. And if they are going to be Chinese investors, SEBI is certainly going to look into it very stringently. The reality is that foreign investors, foreign governments do invest in entities in other countries. For example, take the case of HDFC. The Singapore government itself, through its sovereign funds, holds 3.23% stake in HDFC. India doesn't object to it, and that's because it doesn't come with any kind of inimical or predatory tendencies. It is Chinese investments which come with that, and that is why such alarm bells, such screening of Chinese investments is being done not just by India, but even US, European countries, Australia, Germany, Spain, France, and every other, fearing that their companies should not be taken over at such times because of predatory investor practices by the Chinese government, which don't come with very clear practices at the end of the day. China's reaction against this move by India was swift and sharp. China says that this move by India is discriminatory and that it violates the principles of the WTO. What are going to be the impacts of this move by India as far as Chinese investments are concerned? Indian companies who have a presence in China are going to face hardship because China has a retaliatory law in this regard. So all Indian companies which operate in China are going to face hardship. All the venture capitalists, PE funds which have been investing into startups in India, which source their investments from China, are now going to be capital starved, and the flow by these venture capitalists into Indian startups is going to come to a halt, particularly because there's a huge difference between an automatic approval to an investment and a prior approval. In a prior approval, uncertainty creeps in. The government is going to look into the background of the investors whose money is coming into India from China, and if it finds that the background is not acceptable, it is going to be refused. Whereas in an automatic approval, nothing of this sort takes place. Thus, with the automatic route being denied, these entities are going to face a situation where they could be capital starved. A number of them who have got investments from China already are going to be stuck midway because further investments might not flow in. Thus, the sector is going to face hardship. Some of them have already said that this move in India by India is like a retro tax that was levied earlier. We really don't think so. We certainly think that interests of the nation come first, interests of business follow later as far as this kind of a situation is concerned. And thus, India is right in watching, screening, and doing a basic due diligence on investments flowing in from China before they are permitted. The landscape has changed as far as Chinese investments flowing into India are concerned. This is Akhilesh Bhargava signing off till we meet again. Namaskar.
Now be the first to know about the latest updates on our new news app. Go on your Android or iOS, search for HW News Network. Download our app, choose the language you prefer to get updates in, and be up to date with the latest news.
If you like this video, please share it, and we would love to hear your comments in the comments section down here. Also, please do like our Facebook page and follow us on Twitter to get minute-to-minute news updates. For more such shows and videos, well, subscribe to our YouTube channel.